With stocks down 20% from all-time highs, rising interest rates, and a recession looming, it's more important than ever to have a place to keep your money safe. Money that you might need in the short term for a large purchase, and keep it working for you while not being exposed to the ups and downs of the market in its current volatile state. I'm going to show you 3 strategies you can use to earn interest on your money with extremely low risk. So when the time comes to make that down payment on a house, or college tuition comes due, or it's time to buy a new car, you can trust that your money will all still be there. Stick around to the end where I'll tell you which of these 3 strategies is best for your particular situation and how to actually do them. The first method is going to be a CD, or certificate of deposit. You deposit your money with a bank for a predetermined amount of time. They loan it out to other customers or other banks, and in return, they pay you interest. Number 2 is a T-bill. This is a zero coupon US Treasury bond essentially, which just means that they don't pay you any interest until the maturity date where you get all of your money back. You're loaning money to the US government, and in return, they're paying you interest. Number 3 is an HYSA, or high yield savings account. This is just a savings account at a bank where they pay a higher interest rate to attract your business. Of course, how banks work is they loan out your money to other customers and to other banks, and in return, they pay you interest. So let's talk numbers. These are only going to be current as of December 18th, 2022. So if you're watching in 2046, sorry, these are going to be out of date. You're going to have to do a little bit of research on your own. We're going to start by taking a look at a 1-month term, starting with a 1-month CD, or certificate of deposit. Best option I could find right now is paying a 4.23% APY. APY is just annual percentage yield. That's how much money you earn on your money. To be clear, you're not going to earn 4.23% per month. You're going to earn 4.23% per year. Because you're only having a CD for 1 month in this scenario, you're going to earn 1/12 of that amount. Now, a 1-month T-bill. These are currently paying about 3.95% interest. Now, T-bills are tax advantage, which means you don't have to pay state income tax on the interest you earn. So if you live in a state like California where there's high state income tax, a T-bill, even though it's a lower yield, may be a better overall option for you versus a CD. And for HYSA, or high yield savings account, the best ones I could find right now are paying about 4%. If you agree to loan your money to a bank or to the US government for a longer amount of time, say 3 months, they're going to agree to pay you a higher yield. Taking a look at the 3-month CD options, we're seeing about 4.4% APY. And for a 3-month T-bill, we're seeing about 4.22%. Now, keep in mind, again, these are tax advantaged, so even though the percentage yield is lower, depending on your state's income tax level, it may make more sense to go for a T-bill versus a CD in this case. And now a 6-month period. So for CDs, we're looking at a 4.6% yield, and for T-bills, we're looking at a 4.55%. There are longer term options available as well, of course, but in this video, we're gonna focus on the short to medium term. So let's talk risk. With a CD, your money is locked up until the maturity date. There will be a penalty for you withdrawing your money early. Usually you'll forfeit the last 30, 60, 90 days of interest, or you'll pay a flat fee. It depends on the bank. So to be sure to look into that when you're signing up for a CD. You can also buy CDs through your broker, and then you're exposed to another risk called interest rate risk. When you buy a CD through your broker, you actually have the option to sell it instead of cashing out early and paying a penalty. But this exposes you to a thing called interest rate risk, which means that if the yields of new CDs are higher than the yield of the existing one that you have, the value of the CD goes down, so you would sell it at a loss. This also works the other way. So if yields go down, your CD could be worth more money, so you could potentially sell it for a profit. Now, technically, the bank could go out of business, but here in the United States, we have something called FDIC insurance, where the US government backs your deposit up to $250,000. Other countries have a similar deposit insurance as well. Just look into it if you're not in the United States. Now, T-bills. T-bills are backed by the US federal government for 100% of the amount with no maximum. The US government has never defaulted on a bond payment. Though it's possible in a catastrophic situation, I think that if that happens, a lot of people, a lot of places, a lot of countries even will have much bigger problems. There is no early withdrawal penalty on a T-bill like a CD, but you are exposed to interest rate risk because you have to sell your T-bill to get out of it early. If yields go up in value, your bond will go down in value, meaning if you need to sell it before the maturity date, you may have to sell it for less than what you bought it for. Then again, if yields are going down, you could have the potential to sell your bond for more than you bought it for as well. Now, a high yield savings account is potentially the least risky option. There are no penalties for withdrawing your money early and no interest rate risk. However, the interest rate that the bank pays you can change up or down at any time, so the viability of this particular strategy could quickly go up or down. Your money is FDIC insured up to $250,000, just like a CD. So that money is essentially totally safe as long as the US government is up and running. So when should you use each option? A high yield savings account is the best option for money you might need on a very short notice or in an undetermined amount of time. An emergency fund would be the perfect example of this. Because you don't know when you're going to need that money, you can't guarantee to deposit with a bank for 6 months, for example. Now a CD, at the current rates, is the best yield option for a 1-month term. It's best used in situations where you know exactly when you're going to need that money, and it's very unlikely that you'll need it before the maturity date. For example, college tuition is due August 1st and you know that date. Or you're going to start looking for a house, but not until January 26th. Now, as I mentioned earlier, there's 2 ways to get a CD, either through your broker or through the bank directly. Buy it with your broker if you don't want to create a new bank account and get spam from First Deposit Inc. for the next 12 years, and you don't mind trading interest rate risk for a early withdrawal penalty. Do it through the bank if your broker like Robinhood or Webull, for example, don't offer the option to buy CDs. So when do you choose a T-bill? Choose T-bills when the rate is higher than a CD. It's that simple. Other than the fact that there's no early withdrawal penalties, the interest rate risk is the same as it is with a CD. So just choose whichever one is yielding more for the particular amount of time that you're going to put your money away. Now, how do you actually start? With a CD, you either go directly to the bank's website, or like I said earlier, you can buy it through a full service brokerage. I explained the situations in which you would choose one over the other a little bit earlier. Now with the T-bill, you also have 2 options. You can go to treasurydirect.gov and buy them directly from the US government, or again, you can buy them from a full service brokerage. If you don't have a full service brokerage, buy them from treasurydirect.gov. If you don't have a brokerage and you want one, go look in the description. I put a link to Charles Schwab. If you deposit $25K or more, you can get $100 bonus up to $1,000 bonus. I don't get anything from this, so it's purely just to provide value for you guys. So if you appreciate that, hit the like button. High yield savings accounts are just done directly through the bank in question. Now you're gonna have to go to their website and log in and do everything that you do with your bank through there. So if their website's trash or hard to navigate, keep that in mind. And that's it. 3 easy ways you can earn interest on your money with extremely low risk. If you made it this far, I'd really appreciate you hitting the subscribe button, and thanks for watching.